Hi, I'm Tracy Sofra and this is the Women of Wealth podcast. I'm going to be talking about super funds today, and I'm giggling a little bit because super is something that not a lot of people like to talk about. But really, I'm hoping by the end of this podcast, you're going to have a totally different opinion about super and get excited about it and check your super statement as soon as you finish listening to me. How do I choose a really good super fund? And I hear this often, so I thought, why don't I talk about it in the podcast, and why don't I just kind of outline the main things to be looking for and pretty much, give people some comfort in knowing that super is still one of the best ways to prepare for retirement and to get your money going in there. So let me make a start. Okay, choosing the right super fund is absolutely one of the most important decisions that you will make. Let me just explain this to everyone. Let me explain the obvious. Your employer, if you are employed, and there are self-employed people there, but I'll just park that for a minute. If you're employed, your employer, as of 1st of July 2024, is going to have to put 11.5% of your gross, that's before tax, income into super for you. That's extraordinary. 11.5% of your gross goes into super for you until you retire, reach that preservation age, which is the age in which, when can I touch my super question? And that's different for everyone. But if you're born after the 1st of July 1964, it's generally age 60. And so it is investing for your future self. It's a given. Like, it is literally a given. And so why wouldn't you take this seriously? Most people get their super statement and go, I don't understand it. And it is, like, I get it. It is this lack of understanding. It's the government changing the goalposts. It's a level of distrust. I get all of that. But let's just break it all down and let's take it seriously, because this is going to be one of the most powerful vehicles you're going to have up your sleeve and ready to retire with. I want to outline first and foremost the three main types of superannuation. So we have what's called industry funds, and industry funds are only run to profit their members. What are they? Well, they're like Aware Super, we've got Hester, we've got Host Plus, Australian Super, and so on. They're industry-based superannuation funds. There are also corporate funds, and they're managed by the employer or the company. So corporate funds, if you're working for BHP, they may have a corporate fund that they offer all of their employees. But the main one that I deal with, and most of us, when I say main, I guess, industry funds are the main one as well. But outside of industry funds, it's really retail super funds, and they're generally offered and run by banks or insurance companies to make a profit. What are they? Look, the most obvious ones, let me think. Okay, so you've got Perpetual, you've got AMP, you might have MLC, you might have Perennial. There's a host there. What I've just mentioned to you are fund managers, and those fund managers offer these products in the form of superannuation where you can put your money, and your employer's 11.5. That's going to actually, just on that, that's going to 12% as of the 1st of July 2025. And it's posed to stay there at 12. So again, just do the math. It's extraordinary figures to know that that's what's going into super for you. So you may have an industry fund with, say, Host Plus or Australian Super or, Aware Super or anything like that. Or you may have a retail super fund with MLC, or you might have a BT Panorama or a, IOOF Expand, any one of those super funds. When you're choosing your super fund, here are the things that I want to just highlight that you really need to be aware of. So when you're selecting your super fund, it's really, really important that you consider the following things. Now, what do you want to be looking at? Well, what are the returns? What have been the past returns on your existing superannuation fund? So if you want to do a bit of a health check on your super fund right here, right now, these are the things that I'm about to go into right now. So have a look at the returns that they've had over the last 12 months. So it's usually 1, 3, and 5 years, and then 10 plus years. Have a look at those. Now, we always say in my industry, past performance is not an indicator of future performance, but geez, it's a good guide, right? So, and we don't have anything else to look at because no one's going to project what the returns are going to be. But what we're going to do is look at the past returns and check what they have been and see if we've been pretty happy with them. Analysing that and having a really good look at that. The other really important thing, and I know that this is talked about all the time, fees, and rightly so, the fees that you're being charged in your super can be daunting to look at. You know, from my perspective as a financial planner, when I look at fees for clients who have bought their super fund statements to me, you really got to siphon through the detail to really understand what the fees are. Some of them are hidden in the form of indirect fees. So you'll see the obvious. There may be the obvious admin fee, monthly admin fee. There could be a member fee. And again, this is going to vary from fund to fund. So you're going to have to really dissect and have a look at your statement. But you'll probably have a monthly member fee or an admin fee. And then there will be the fees that the actual fund manager will charge you for investing in their particular funds, depending on how you've invested your super, whether you've invested it across a multitude of investments or whether you've just gone with the pre-populated, core portfolio that is the default one that's there. You want to make sure that you're checking those things and what the fees are attached to each one of those. Don't confuse any insurances that you may have in your super. That's not a fee. That's actually an insurance premium. And also the tax on contributions and the tax on the growth of your super fund, the profit that it's made. That's a given. Every super fund is taxed at 15 cents in the dollar. And what is taxed? Concessional contributions, which is your employer one that goes in, anything that you put in the form of salary sacrifice or personal after-tax contributions, and any money that it's made as well. And that's only 15 cents in the dollar. It really is the lowest tax environment that we have. But don't confuse those with fees. I'm talking about the actual fees of running the fund. So what are the admin fees? What are the member fees? What are the management fees of each of the investments that they're charging? Over and above that, that will be generally easy enough to see and find. But over and above that, you may see somewhere where it says, and here are the indirect costs. And the indirect costs are not so obvious. So you're going to have to drill down into this. And it's a bit hard for me to kind of talk you through this without showing you an example. But what an indirect cost is this. When you have an investment in super, it's always explained in this way. How many units you have, what the value of those units are. If you multiply one by the other, that's the value of your portfolio. So generally these indirect costs are factored into the unit price. So if the unit price was $1.50 and they want to take their fees out, the unit price will drop to say $1.30, and therefore the value of your portfolio, because $1.30 over say 10,000 units is a lot less than $1.50. Yeah. So that's how they've taken their fees out, by reducing the unit price, and therefore your portfolio value is less. That's what they call an indirect cost, but it's still a cost, and you've got to factor that in there. So fees are really, really important because it will eat into your super over the long term without a doubt. Having said that, though, don't go off on a tangent. I see this a lot. Don't go off on a tangent expecting unrealistic fee levels. Anything up to 1% and above in super, that's pretty high in fees. I've got to say, I can kind of pretty much say that off the top of my head. Anything between a 0.4 or 0.5%. And what I'm talking about is 0.4% of your account balance, the total account balance. They're generally a lot cheaper. So keep a mind on that. The other thing is you want to look at the investment options. What sort of investment options do they have? And what have they looked like over the last, again, 1, 3, 5, and 10 years? And looking at the investment options in the form of providing you with an array. And that's really, really important. If it is quite limited and there's not a lot of options there for you, that's pretty much something that, you want to be reviewing pretty quickly. You should also be able to switch. It's called a switch. So say you've gone from Again, let me use some terms to make it easy. Say you've gone from, and they'll have portfolios called balanced growth core portfolio to a conservative core portfolio, something like that. If you've started off as a conservative and your risk profile has gone up, that's your tolerance to risk, and you're more comfortable now with investing in a little bit more property and shares, and you've gone to a balanced growth portfolio, what you want to be doing is being able to actually action that. That's called a switch, going from one to the other. And you should have the option of having an array of investments to be able to do that. And that switch shouldn't cost you any money either. So keeping a mind on that. So I'm drilling down into particular specifics. But you've got to get all over this because, as I say, it's just a given. It's 11.5% about and going to go to 12 the year after. And that's just your employer. And I'm going to talk about other contributions in a sec, which makes super really powerful. But while we're on reviewing your super statement, let's keep going with that. And let's talk about insurance. So the typical insurance that you will have inside your super will be life and TPD, total and permanent disablement. They're a given. Should they be inside super? Absolutely. Why? Well, the premiums of those insurances are tax deductible to your super fund and therefore will reduce the profit of your super fund, and your super fund will pay less tax. If you had life and TPD outside of super in your own name, it's private in nature, so you will not get a tax deduction for those premiums. And when you do have life and TPD inside super, if anything does happen to you, that policy will pay out into your super fund, and combined with your account balance will be either paid to your beneficiaries, your nominated beneficiaries, or to your estate. So it just makes it nice, neat and tidy and in the right place. The other type of insurance you can have inside your superannuation is income protection. Preferably for me, it is better outside of super for a couple of reasons. Income protection is what we call otherwise deductible. It is deductible to the premiums that you're paying on that policy is deductible to you in your own name. You can claim it in your tax return. And also because you are the policy owner, it's outside of super, it just gets paid to you on claim. If it's inside your super, one, it's reducing your super even further because the premiums are coming out of your super fund. Yes, it's tax deductible to your super fund, but it's tax deductible to you too. And when it is paid out, if you do claim, you want to be checking with the actual superannuation fund, and they want to be checking the fine print in their trust deed to work out whether those premiums that are paid into the super, because the policy owner is the super fund, not you, if it's inside super, can you actually take that out to support your income when you're during claim time? That is a little bit of a hiccup that you can experience, and it depends on the super fund. But really, really important for me to make mention of this because I've seen this in the past where the member, the policy owner being the super fund, claimed, the claim went into the super fund and they couldn't take it out of there because generally speaking, super is preserved until such time as we retire. But in the trust deed, it must have that exemption of being able to be paid to the member at claim time. Getting a bit technical, but really important for you to note these things. So insurances will reduce your super over time. Life and TPD, yes. Income protection, no, preferably. However, having said that, if you absolutely need income protection and you can't afford it yourself in your day-to-day living, in your cash flow, well, then you're better off having it than not having it. That's my general rule of thumb. I would then have it in super if you had to, rather than not having it at all. I would protect yourself rather than not protecting yourself at all. And the final thing is some super funds, particularly industry funds, and it won't be retail funds, but particularly industry funds, they have availability for affordable advice to help you make decisions. Now, you need to be mindful of that. The industry is going through a lot of change. They're not really poised to be able to give this direct financial advice. They're not qualified to give financial advice. But what they can do is you can call their call centres and their helplines, and they can give you specific information, such as what I've just spoken about in terms of getting your income protection paid out to you in that particular situation, drilling down into the fees. If you're unsure, they should be able to spend time with you, going through your statement and really drilling down into each individual thing that I spoke about, whether it's a monthly membership or or a admin fee, and then obviously the admin fees of the investment managers, and then the indirect fees. That is the reduction in the unit price, because when the unit price goes down, the account balance goes down of your super, and that is another way of showing that those fees have actually come out. And that's why they call it indirectly, because it's not specifically itemised, just like the insurance or the tax or the other fees. And also, if you're wanting to get more information around your investment and the investment options that are available to you, they should also be able to help you with that as well. But it's critical that you look at these things, because again, as I always say, and I've said to all my beautiful members in the Empower program, your financial life is now part of your life, and it is what you do. So we've got to embrace it. We've got to get all over it. And the sooner you get all over your super, the better poised you're going to be and the better position you're going to be in. I've come across clients who have had their super sitting in cash unbeknownst to them. Can you imagine sitting in cash for, and these are people who have had, say, an investment time frame of 15 to 20 years. So I've spoken about investment time frames a lot in the past, but investment time frames pretty much give you a really good indication as to how you should invest your money and the notion of risk. So if you've got 15 to 20 years to invest, absolutely you should be investing in property, shares, fixed interest and cash, and to a high degree in the property and shares arena, because you've got 10, 15, 20 years to adjust to the volatility that occurs during that cycle or that period. So it's really, really important to understand those concepts as well, and making sure that you are pulling out that statement, sitting there with a cup of coffee or a wine or whatever floats your boat, and getting stuck into it. Get a trusty highlighter. That's my favourite thing. I love yellow. I get my yellow highlighter and I highlight, and I circle and ask questions, get on the phone and drill down into it. And, it might be uncomfortable the first time, and then it might get easier the next time. But by the third time, you're going to feel a lot better. And that weight off your shoulders, you're going to get rid of that monkey off your back and progress forward with your super. It is amazing. And I'm about to explain why. But let me just, before I jump into the end game plan, let's talk about why super is so important. So I opened with saying the 11.5% going to 12. That's a given. There's two main types of contributions for your super that you need to be all over, absolutely. The first one is what's called concessional contributions. They are inclusive of your employer, which is the super guarantee at 11.5 going to 12. That's in there. If you do salary sacrifice, which is before tax, that's in there. If you don't do salary sacrifice, you do it after tax, you put money into super after tax, which is fine. That's in there. That is capped from the 1st of July at $30,000. So the first thing you'd work out is what your employer's putting in there, and then work out the difference between your employer and the 30 grand. Then you know how much more you've got to go by the end of the financial year, that you can maximize that if that is your strategy. If you're getting closer to retirement, you probably want to incorporate that strategy a little bit more. If you've got 10, 15 years, you might do it to a certain extent. Again, that depends on your taxable income. If you're a high income earner, there may be some tax planning opportunities there. Because I always say, because being a tax accountant, I don't like tax very much. I like to minimise it. So if I've got to part with some money, I'd rather part with money that I put into super that one day I can access, rather than give it to the tax office and never get it again. So if that means I've got to put some money into super to do that, well, so be it. I will do that. But it's a mindset shift, right? So I want you to kind of think of investing, think of super, think of, your returns in that sort of light, Because I have come across people that have said, no, not putting money into super, I can't touch it, Well, would you rather give it to the tax office? Because as an example, say you're a high income earner and I've said, look, Janine, if you put $5,000 into super, your tax bill's going to be eliminated, or your tax bill's going to go from $4,000 to $500. No, I don't want to put money into super. Well, wouldn't it be better to put $5,000 into super and pay $500 tax instead of the alternative? Just makes common sense, right? So be mindful of those things. But that's concessional contributions. So that is one of the ones that we use all the time, because it's made up of your super guarantee from your employer. The other one is called Non-concessional. Now, that is about to go to $120,000 a year. It's 110 at the moment, but from the 1st of July 2024, it's going to 120 per annum. That one goes in tax-free, so it doesn't get taxed, whereas the concessional gets taxed at 15 cents. But remember, you get a tax break for it as well, right? So the non-concessional goes in tax-free, and you don't get a tax deduction for it. When would you do that type of contribution? Probably closer to retirement, if you're planning to get some non-super investments into the super arena in preparation for retirement. So you want to be thinking about this at least 5 years out to kind of really consolidate and have a look at the big picture of where you're going, because the end game, what's the, let me just jump to the chase and talk about the end game. What's the end game here? Here's the end game. Superannuation, once you retire, goes into pension phase. So it goes from super to an income stream called an allocated pension. It's an account-based pension. After the age of 60, that account-based pension, if you leave the capital, you don't pull it out, you're simply rolling it into an account-based pension. It's called an allocated pension, that vehicle. It all becomes 100% tax-free. The capital withdrawals, which you don't want to be doing, basically you want to keep it invested and you want to draw on a fortnightly basis to live tax-free. You can increase the payments, your income payments, every single year. You can withdraw lump sums whenever you want. You can pull out the whole lot if you want the next day. It's totally up to you, all tax-free. Within that product, you nominate whether it's going to your legal personal representative or your, if you're partnered, in the eyes of the tax office, you are always financial dependents of each other, so it goes to each other tax-free, or you leave it to your beneficiaries. The actual capital, which is the lump sum of your super that's now in this tax-free environment, is invested. It makes money and comes in, and your income comes out. And it's just a matter of balancing that capital of it making money, you pulling money out. Yeah. And that is, again, part of your new financial life, which is what you do, is stay all over that. So the investment of those funds are still as important as it was in super, but now it's providing you with an income stream that's tax-free. So that's the end game of why super is so important, and you should be all over it right now. That's what I'm trying to get to, because if you don't know what the end game is, it's sort of like, well, what are we doing here, Trace? Why do you want me to put so much money in super? Well, obviously it's tax effective to maximise your concessional contributions, particularly if you're a high income earner. Obviously the end game, when it's tax-free like that, well, who doesn't want to retire like that? And it's, all the retirees that I've worked with for over the last 35, 36 odd years, this is how they've retired, on an allocated pension. And there still isn't anything any better than that product right here, right now. And let me explain one other really pertinent, important piece here. In the middle of the pandemic, when the market dropped 30%, all of my allocated pensioners, their income and their lifestyles did not change. Their nominated income amount for that year was continued to be paid, even though their account balance had dropped 30%. We all did, right? Anyone invested dropped 30%, and we recovered within the month or so. I can't really remember how quick we recovered, but we recovered for obvious reasons, because it was external factors, just coming back to some other lessons, external factors impacting the investment, and not the fact that the investment's really bad. Yeah, investments aren't bad. They were great. They were impacted by being told that there was a global pandemic, so everyone got panicked. So what I'm trying to say is this particular product, which is an allocated pension, irrespective of what the capital's doing, it's not going to impact your lifestyle. You've chosen 60 grand for a year, 80 grand, whatever that might be. You're going to get paid that irrespective of what happens to the account balance. And it's a moving target, and shifts and molds, and away you go. The secret is to make sure it's managed appropriately according to your risk profile. Again, there's that risk profile concept coming back, and that it's making money, and that, again, if it's making 8, 9, 10% and you're taking 6, 7, happy days, it should. And that's on average over the long term. It's not like a term deposit. It's not going to give you 8, 9% every single year. But on average over the long term, if you look at averages, that is what you should receive. And if that's how you're managing it, which is how you should be managing it, capital preservation's definitely on the cards. But again, one other thing, I have worked with clients who, I've said, gosh, you guys are taking out, I think it was around the 12 or 13%. I said, gosh, and they've taken out a few lump sums, which reduces the capital, and therefore your averages go higher and higher. They were taking around 13 to 14, maybe 12 to 13, 14%. And when I said, being part of my job, gosh, I'm not sure how long we're going to be able to sustain this. And you can have periods of time, like, without sort of overcomplicating this, but I'm trying really hard to express how flexible this actually is. You may have periods of time for 12 months to 2 years where you actually need to do that, and then you come back down to your 6, 7%. It's all totally flexible. But these guys were doing that for quite some time, and when I brought it to their attention, they said, no, Trace, we'll leave it. The kids have got plenty. They've got the house. They've got this. They've got that. We need to live. We're happy. Happy days. So for them, capital preservation wasn't a huge deal, and that's okay. This is a values question, isn't it? Depends what's important to you. There's no hard and fast rule. Generally speaking, most people love the thought of capital preservation, but those that don't care, happy days, and away you go. So that is why it is so important that super right now, and I don't know where you are in your investment time frame. Have you got 10 years? Have you got 15? Have you got 20? Have you got 5? I don't know where you're at, but that is where super is going to. That is where super should go to. It's extraordinary, and it's flexible, and it's easy, and it just makes life so easy. So when you can see that and think of that, it will change exactly what you're thinking about your super right here, right now, and get you off your bike and get you going. So check those statements, review your super, make sure you're in the best one, check the fees, check the insurance, check the investment strategy, check the whole lot, and make sure you're poised and ready for when you're about to retire and get that beautiful tax-free environment and that tax-free income that gives you the flexibility to live exactly how you want. I hope that has really opened your eyes to super, and I hope you're getting excited as we speak and about to jump off and say, Trace, I'm done. I'm ready to go. I'm going to get my statement. Don't forget to get your super statement to check that out. Make sure to subscribe to our podcast on your favourite platform, and make sure to check out my previous episodes. It's been a pleasure chatting to you.